When we restarted this whole credit initiative back in 2021, there were some fundamental changes in regulation, like margin rules for OTC derivatives. We had technological developments which helped to price hundreds and thousands of bonds. There was much more electronic trading in the underlying market going on. We had buy-side firms who indicated interest to use a different product, a more efficient product, for a similar purpose where they in the past have used other products. For us, this was kind of the starting point to say, okay, this product now might have a chance.
What differentiates credit index futures from other alternative products?
I'd say there are three different products which are kind of competing with this new product. The first one is the credit default index swap products based on iTraxx and CDX. Then we have the total return products or the total return swaps on fixed income indices, and the third one are credit ETFs. If you compare it one by one, I'd say for the credit swap, the difference is the credit swap is a highly liquid product, but the underlying index is the iTraxx index has a much worse tracking error than the indices we are using in the credit index futures or some Bloomberg indices. So credit tracking error is an important element from a buy-side perspective. Second thing is it's more margin efficient than the credit index swap because from a margin rule set perspective, futures run on 2-day margin period of risk, whereas swaps run on 5 days, so much more margin efficient. If you compare it with the second product, which is an OTC-traded total return swap, it's an OTC product. You have low price transparency, you have relatively low liquidity. The tracking error is very similar to the credit index future, but the transparency aspect on the future is very important, and the liquidity aspect is much better on the future. And you have the same advantage on the margining side. Again, we're talking OTC margin versus futures margin, so here a clear benefit for the future. If you now compare it with the last product on the ETF side, which has a very comparable liquidity and risk profile, but it's a cash product. So the money you need to get your exposure to work is much higher on a cash product than on a derivative product. And this is the big advantage of the future. You can generate the same exposure with much less capital you need to put in. The credit index future is taking the best elements out of these three products, combining it in a new way and creating, from our perspective, a superior product relative to products which people have used in the past.
Is the product successful so far?
If you build a new product, you need to mobilize different stakeholders. And if you look at the stakeholders you need to mobilize, we're talking about liquidity providers, both on book, so in the order book, but also off book. You need to mobilize clearing brokers to put this product into their service offering and being able to provide these clearing services to end clients. And you need the execution brokers to sell and market this product to these end clients. And last but not least, of course, you need the end client who generates demand for that product because they want to have it. What we have seen is we have made it work in the last 3 years to get all these kind of 5 stakeholders to work at the same time. The result is that we have this great product. We have 13 on-book liquidity providers. We have 7 off-book liquidity providers. We have a number of clearing brokers offering the service. So all the ingredients are there, and that is now, after this pioneering work of 3 years, we have seen that volumes in the last 2 quarters, in the second and third quarter, have kind of quadrupled relative to the quarters before. 40 buy-side firms active in this product. and we get so positive feedback on the product. For me, this is really a significant area of growth for us as Eurex in the years to come, and we see really a great outlook for that product.
What are the factors for that growth?
Depending on from which product they are coming from, so people are using certain products today, like what I said, credit swaps, total return swaps, or ETFs, and because it's a much more efficient product, it irons out a lot of the negative sides the other three products have, and that is where you see people migrating from those products over to this standardized futures product. This is at the end driving the growth, and as I said, it's more margin efficient, has a better tracking error, it has a high level of price transparency, there is a significant liquidity in the book and off book. In the combination is nothing any of the other three products really has.
What has the open interest done?
The open interest has significantly increased to, in the meantime, 2 billion. It's coming from 1 billion 12 months ago. Even more progress we are seeing on the trading activity. In the third quarter, we have traded close to 20 billion. This is an increase coming from more 5 billion 12 months ago. So quite significant increase on both fronts.
What does the future bring?
We want to make the product even more margin efficient by moving it from an isolated product into the broader fixed income liquidation pot, so that you have a cross margining with one bubble charts futures, for example, to create further efficiencies. That's one. I think second is that we want to build out further from a client base. I mean, we want to win more traditional asset managers to use the product. And we want to expand the client base to also make hedge funds and CTAs use the product, of course, and to make increase the ease to use the product by further integrating with order management systems and execution management systems is a very important project, that people sitting on the desk have the analytics available on their screen and have the windows to trade the product available on their screen is a very important next step. So all in all, I think there is a bright future for this product, and we have been the innovator, and we hope that the credibility and trust we have built with existing market participants allows us to be the choice or the partner of choice for future market participants who want to do this product.
Is this product available to trade in the US?
So the product is a CFTC approved product, and we are allowed to distribute the product into the US, and we see also US firms using the product. At the beginning now, of course, we started off with euro-denominated products with focusing on a European client base, but we have expanded our product spectrum covering US dollar investment grade and US dollar high yield products in September. And we have seen in last week's first trades also coming out of the US.